Halo, kembali lagi di channel GRW. Bersama saya Maura, and today we have Mr. Sebastian back here with us. How are you today, Mr. Sebastian?
Good, thanks. Good, thanks.
Okay, and maybe there's viewers who just joined our channel. Maybe you could introduce yourself shortly to our audience.
Okay. Hi, my name's Sebastian Sharp. I'm from the UK, but I lived in Indonesia for about 30 years. I've worked in investment banking all that time, and I do analysis of, not really analysis, but looking at company financials, and now looking at cash flow for both Indonesian and US stocks.
Okay, so, and again, 30 years, that's a very long time. It always surprised me every time.
Later, it will not surprise you.
I'll get there someday.
Yes, we all do, I'm afraid.
Okay, Mr. Sebastian, today we will talk again about the US stock market and also about the cash flow. And I'm kind of curious, Mr. Sebastian, what is the biggest misconception that people usually have about the US stock market?
The biggest misperception about US stocks, I think people generally think over the 30 years when I've been looking at it, they normally think that the market like Europe or US is slow growing and the emerging market is fast growing.
Oh, okay.
But in reality, it's the other way around. So the US has been the fastest growing economy in the world.
And maybe because the US is a very big country as well.
Yeah, people think because it's so big already and it's already so, the economy is already big, that it cannot grow faster.
Any bigger.
But it's not true in reality.
Okay, so because the country is big and everything is just changing so fast, so the US market is also growing that fast, right?
It is growing tremendously. It's the fastest growing in the world. Yeah.
Okay, Mr. Sebastian. So lately, there are tech giants dominating the headlines, right? Like the tech industry is growing even bigger now. So how can retail investors spot opportunities outside the mainstream names?
Yeah, that's a very interesting topic, I think, because at the moment, the tech stock is still dominating. Nvidia is now the largest stock in the world.
Nvidia?
Used to be Apple.
Yes.
Apple became 1 trillion, 2 trillion, 3 trillion, 3.5 trillion, but now Nvidia is 4 trillion. So Nvidia
is catching
has
up.
caught up, taken over, and now Nvidia is the number one.
Oh, okay.
So definitely the tech stock is still in focus, and obviously the AI chips related to AI. But if we look at the performance of the cash flow, actually we see a little bit different, and that is that some of the raw material like commodity is doing better now.
Commodity,
so the tech is still doing well, but the one that's coming up, I think, is the commodity.
What kind of commodity?
Well, if we look at, so right now we're in the middle of the results coming out.
Okay.
So we have about, still a long way to go, but we have about 30% of the US stock we cover already reporting the second quarter.
Okay.
And maybe people will not be surprised that some of the best, the fastest growing cash flow is the gold company.
The gold company, okay.
Because the gold price went up.
Yeah, one of the favorite.
Gold has been a favorite as gold, but until now, not really the mining company shares.
The
but
mining
now
company
when we look at the mining company shares, they are making more cash flow now.
Oh,
definitely.
I see. Okay, Mr. Sebastian. So let's talk more about companies' financial health. Do you think it's important for us to know about the company's financial health before we go into the US stock market?
Yeah, I mean, that's Sharp Focus, my company, we're all about the financial health. Because a lot of people, they focus on what is the hot story or the hot stock. That's more to do with what people say will happen in the future. But for us, we're interested only in what is happening in the present, not in the future. We never, ever forecast for the future.
No predicting.
So instead of looking at the story or the news or the, what people say is going to happen in the future, we just look at the financial numbers. And I mean, everybody have their own style, but for us, that's the most important. So yes, the financial health is the most important.
Okay, Mr. Sebastian.
Because sometimes, or quite often, it has a different story compared to the story.
Exactly, that sometimes happens, or maybe oftentimes happens, the difference. So, in your personal view, how often should an investor actually read financial statements or the earning reports of a company, or maybe the cash flow reports of a company?
Well, we're very lucky here in Indonesia, it's the same as the US. The companies have to produce financial reports every 3 months.
Okay, per quarter.
Per quarter. That's not the same all over the world.
Oh, okay.
In my country, England, UK, it's only twice a year.
Twice, so every 6 months then?
Every 6 months. So, but we're lucky in the US because it's every 3 months. You can look at the financial statement every 3 months.
3 months.
And then you will get some update to what's going on. In the UK, you have to wait another 3 months.
3 months. Okay, Mr. Sebastian. So every 3 months, so every quarter.
Yes.
When the report came out, that's when you have to look at the report. Okay. So in a company, there are various financial statements, right? There's a balance sheet and then cash flow and then income statement and many more.
Yeah.
Right? But the cash flow is the one that we want to look more closely.
Yes.
Right. And why do you think we have to look more closely? And maybe is there any connection between the balance sheet, the cash flow, and income statements?
Oh wow, that's a complicated question. The only thing, when we do our data updating, we only put in 2 numbers.
Okay.
So from the whole financial statement, we only take 2 numbers. The first one is the asset. So we want to know what is the asset of the company. And then, so it's 3 numbers. We look at the operating and investment cash flow.
Okay.
And the total from those is the cash flow. So operating and investment is the cash flow. So we add those together. Normally investment is minus. So you've got operating plus, investment minus. The total of that is the cash flow
of the company.
And then the only 2 numbers we use is the asset and the cash flow. And then we want to know how big is the cash flow compared to the asset.
Okay, I see.
If you want to know about how it's related, cash flow in the US is pretty good. So cash flow should be the same as the profit in the long term.
In the long term.
So many people look at profit. The only thing is the profit is not real. It's adjusted. The cash flow is real. So there can be a difference between the profit and the cash flow. But the cash flow is the real one. So that's why we use the cash flow.
So it's just better to just focus on the cash flow.
Better to use the real number.
The cash flow numbers, yes.
Yeah. So that's all we look at. We can analyze a company in 1 minute.
And that's very fast.
Yes.
In 1 minute, you can make a decision.
It means that we can do a lot of companies. So we can look for more opportunities.
I see. Okay, so for beginners, let's say, how could a beginner differentiate between a strong cash generating companies and the one that is just, let's say, popular by name because the company is already big?
Yeah, well, that's why we measure the cash flow against the asset. Because you want to see if it's big relative to the asset. Because obviously, it could be a big company, could be a small company. So you can't just look at the cash flow by itself. We want to compare how well the company uses its assets. Because we always compare with because you always have an opportunity to do something low risk, which is just keep your money in the bank.
Yes.
So in the bank, you will earn interest. And if you set up a company, you take your money from the bank in order to set up the company. So you want to know, is it better to set up the company or better to put your money in the bank? So we're comparing how the company uses the asset, because that asset could be just in the bank. So we want to know that it's better than the bank. So it's not only the cash flow, it's how the cash flow compares with the asset of the company.
Okay.
And obviously, if that ratio, which is like a percentage, right? So maybe your interest could be 4%.
In a bank.
Yeah. So if your cash flow is 4% of the asset,
It's better just put it in the bank.
in the bank. Yeah. If it's 10%, then
Of course,
it's better
to put it
have
in
the
a company.
Yeah.
Okay, I see. So they can differentiate it by comparing then.
Yes. So we're comparing the opportunity cost. Is it better to
Opportunity
do
cost,
nothing
okay.
and just keep your money in cash? Or is it better to put the money in the share of that company?
Okay.
What we're looking at is because in the market, people get confused, right? Because many things happening every day, sometimes up, sometimes down. So we don't want to focus on that. We want to think not like a trader in the stock market, but like an owner of the business.
Okay.
So that's why we look at the cash flow compared with the asset. We want to think the same way that the owner would
Owners
think.
of the company.
Yes.
Right, so that's a different mindset.
Yeah, it's a very different mindset, and that takes you away from the market. Of course, you are dealing with the market if you buy and sell the shares, but in terms of looking at the company, is it good to buy the shares or not to buy the share? We take a step back from the market and think like the business owner.
Okay, so you have to have a business mindset. I think it's better to do that in the US stock market.
Yeah, because in the end, the shareholder who is the most well-informed is the owner of the company. Right? If the owner of the company is selling the shares, then maybe you don't want to buy the shares. So we want to think like an owner.
Okay.
That's why. Because they know the most.
Yeah. Okay, they are the most informed.
They are the most informed, yeah. They know what's happening.
Okay.
So we want to make our thinking, even though we cannot know day to day what's happening in the company, but we want to try to think like them. And every 3 months they give us some information which help us to think like them.
Okay, Mr. Sebastian. So, up to the next question. Is there anything about the cash flow reports that the investors should be aware of?
Yeah, I mean, nothing is ever perfect. Excuse me. Nothing is perfect.
Okay.
So there will always be, if it was perfect, it would be easy and everyone would do it.
Yeah.
So cash flow is cash flow, but it could include things which only happen like one time.
For example?
So it's not like, so for example, companies may sell asset.
Oh, yeah. Okay.
And so you might get a gain in the cash flow because they sold it and they got the cash. But that's only just one time. It's not really a reflection of how well the business is doing.
Okay.
And then also you can have large working capital. So maybe they make a whole load of computers, but they didn't sell them yet.
Oh, okay.
So the cost went up, but it's not really reflecting how the business is doing. So, but in general, those things, okay, they happen once or twice, but it kind of evens out.
Oh.
Because later they will sell them, and so the cash flow will come again. So as long as you look, so it's important, I think, to have also a bit of a longer term feeling. So we look at what's happened in the last 12 months. So we got 1 year of data, but you might want to know what happened in the year before and the year before that.
Okay.
So you can see, is it something unusual or is it part of a trend?
Okay, so sometimes it's not.
Sometimes you need a little bit more information.
Step back.
Sometimes.
Okay, so maybe looking back like a year before or 2 years before.
We look in so when we publish our numbers, we look at 3 years.
3 years.
Yeah. So if 1 year is something funny happened, then you will still know from the other 2 years.
Okay. Is there any specific reason why you chose 3 years as the time frame?
Just to make it simple. Because if we want to cover hundreds of companies, if we did 10 years, that's
that would be too long.
There's a lot of data that would take a long time. Yeah. So we want to make it something which is, okay, it gives a good picture of what's happening, but it's not too complicated. Just keep it simple.
But enough to give you some kind of
enough
overview.
to give you an idea.
Okay, Mr. Sebastian. So, do you think that the market timing plays a big role in the US stock market, or is it more about consistency?
Well, that's why. So what we do, so as I said before, our numbers, our data is comparing the cash flow with the asset.
Assets, yes.
Okay, that's one side, right? We want to know how well is the company doing. The second part, we want to know what the market is expecting.
What the market is
So I said
expecting,
before, we're taking
okay?
a step away from the market in order to think like a business owner. But if, let's say the company is good, it's producing a lot of cash flow. Let's say the bank is 4%, the company is 20%.
20%, okay.
That's good, right?
Yes.
But we need to know the price of the share. Is that below or higher than the cash flow? So is the market expecting 20% or is it expecting 30%? So you've always got to compare. Like we want to compare the company with the bank. Is it better? Then it's good. But then we have to compare the market with the company.
Oh.
And so the way we do that, this may sound a little bit complicated, but it goes back to the bank, right? So if the market value, let's say the asset is 100.
100, okay.
If the market value is 100, the bank is 4%. It's 100 divided by 100 is 1. 1 times 4%.
Okay.
Meaning the market is expecting that company to produce 4%.
Okay.
You see what I mean?
Yeah.
If the asset is 100 and the market cap is 200,
Okay.
it means the market is expecting 8%,
8%.
2 times 4. Okay?
okay.
So let's say the company is producing 8% and the market is thinking 8%, then it's matching. If the company is producing 8%,
8%.
the market is thinking 4%,
It
there's
pays more.
some opportunity for us.
Okay.
So we need to compare the company with the bank and the market price with the company.
The company. Okay.
And that's how we can see whether it is likely to be attractive to buy the share or not.
Okay. So still the easiest way, no, not the easiest way, but the first step we could do is to compare the company with the bank first.
That's the first step. That's where we look at the financial statement and we take a step away from the market. But then we have to see what is the value of the company in the market and how does that compare with the cash flow return from the financial statement.
Okay, I see.
So it's two parts.
2 parts, yes. But that 2 part is the only thing you have to do.
That's
right?
it, yeah.
That's just
It's
enough.
as simple as that. I mean, maybe it sounds something different, but if you talk about how long it takes to make that calculation, you go to the financial statement, you take the asset, you take the cash flow, you have the ratio.
Yes.
You get the market value of the company, you compare to the asset and the risk-free rate, you have the other ratio. 2 ratio, you compare one with the other, that's your answer. You can do it in about 2 minutes.
That's very fast.
Yeah.
As long as you know where to look for the data.
Well, it's taken us a long time to realize how you should look at the data. But once you have that information, looking at the data is very fast. So we don't need to know what's happening with the sales. We don't need to know what's happening with the costs. We don't need to know what's the margin. We don't need to know what's the debt. We don't need to know all these kind of things. Only this very simple information.
The asset and the cash flow.
And the market value.
And the market value.
And the risk and the bank rate.
And the bank rate, yes.
So I guess that's 4 pieces of data. That's it.
4 pieces of data. Okay, Mr. Sebastian. So, how do you balance using technical indicators with fundamental analysis, especially, let's say, if you want to look in a short-term time frame?
Well, technical for us is the difference between the 2 ratios.
Okay.
So that's the technical. If the share price value is 4 and the company return is 20, technically it should go up. If the other way around, so the cash flow return is 4 and the market is 20, it should go down. So the technical is comparing the two numbers.
Okay.
So you can do that at any time, depending on what the market value is, which changes every day.
So you just
to
have
give you
to
an
look-
example of how this works, right?
Okay.
I'll give you a very simple example. If you go back about 6 years, 7 years, right?
Okay.
At that time, Apple was about 1 trillion market cap. The cash flow return compared with the asset, 35%. Very good, right? Compared with the
35?
bank, 4%. Apple was 35%.
35%. Wow.
Then if you measured the market, what is the market predicting? Only 10%.
Ooh.
And what happened to the share price of Apple? It went up 3.5 times. So today, Apple cash flow market, the two ratio is roughly the same. But before, the market was far below the cash flow.
Cash flow.
And so technically, Apple was a great opportunity. And that's what happened.
If
So
you look
that's
back
how it
6
worked.
years ago.
Yeah, so the technical is that moment in time, what is the difference between the two ratio? If it's a very big difference and the market is far below the company cash flow return, technically
will
it's
go up.
very, very attractive. It doesn't mean it will go up. You don't know when it will go up, but that's the technical, is the difference between the two.
Okay.
So ours is a combination of the fundamental, the market price, and the technical difference between the two.
Okay. So, and again, we just need to look for the numbers and look at the right numbers then.
Yes. Yes, like many things, you could look at hundreds of numbers, but in reality, the important one is only one or two. And I think there's another important lesson from this, which I saw some famous investor talk about before, particularly private equity investor.
Private equity investors, okay.
They said some of the one that is very successful, because most people when they're buying and selling shares, they will tend to buy and sell quite a few different ones, right?
Yes.
They think it's better to spread rather
to
than
differentiate.
focus. Yes. But the reality is no. You should focus from, like when we look at these numbers, not many are attractive, right? Like Apple at that time was very unique.
Okay.
So you don't need to invest in anything else.
You just need to invest in
get
Apple.
the good one where the technical difference. So the company is very profitable, cash flow. The market value is very low. You
And
only need
that's it.
one. You only need one, not many.
Okay.
So that is, once you've got all the data, you can see the numbers, then you only need to pick one, maybe two. That's it. That's enough.
One or two of the most attractive ones.
Yes, and you know which one is the most because you already have the numbers.
Data.
Yeah.
You already know the data and you already do the research about the numbers.
Yeah.
Okay, I see, Mr. Sebastian. So, if there's anything you want to say to our viewers back at home who's watching this video right now about how to invest in the US stock market, or maybe something about the cash flow, what would you say to them?
I think I say one more thing. So what we just described, let's say that it doesn't work and the share price doesn't go up. It looks technically perfect. All the data you have is correct. You don't need to worry, because if the company generate high cash flow and the market value is much lower, you will get a big dividend.
Ooh.
So you can wait. Easy, because you will earn a large dividend from this kind of company.
So
you imagine if the cash flow is 3 times compared with the market, that means if it's the same, you will get the dividend matching with the bank, 4%.
Okay, 4%.
If it's 3%, if it's 3 times, you will get 12%.
12%.
12% a year is not bad, right? So even if, obviously it's the best if the share price increase, but you can afford to wait because you will get the cash flow from the dividend. So the great thing about cash flow is you will get the cash flow even if the share price doesn't
Go up.
move. Yeah.
Oh, that's interesting.
Yeah, so we can also try to reduce our risk, very, very low.
Low risk.
because of cash flow, because it's real cash flow.
So that's another importance of the cash flow then.
Yes. So that's everything I know in whatever it is, 10 minutes. The only advantage that we have is we do the work. But if people want to do it by themselves, they can do it by themselves too.
Okay, because it's very easy now and very simple to do.
You just have to trust. You have to trust. That's the thing. Because most people, they don't do research like that. It's not very common. So people will not be sure if they should follow that. But if you trust it, it's very simple. Yeah.
Okay, Mr. Sebastian.
Anyone can do it.
Anyone can do it as long as they're willing to do it.
Yes.
Okay, Mr. Sebastian, thank you so much for your time and for your insight about the cash flow again today. And for all of you, kalau teman-teman merasa hari ini insight-nya bermanfaat dan ingin belajar lebih dalam, mulai dari investasi, kemudian saham, forex, dan lain sebagainya, teman-teman bisa juga nih untuk bergabung ke channel Telegramnya GRW. Nanti teman-teman akan dapat insight harian, kemudian update market, dan kesempatan untuk belajar langsung nih dengan para teachernya. Kalau teman-teman ada yang tertarik juga nih untuk mendalami pasar US market, atau strategi trading, atau pengen tahu lebih dalam nih soal cash flow, setelah bergabung dengan GRW, teman-teman juga bisa nih kita hubungkan langsung ke Mr. Sebastian. So Mr. Sebastian, once again, thank you so much for your time. It's been a pleasure talking with you. And it's been with me, Maura. I'll see you again in the next episode. Bye.
Bye.